You're now live.
Okay, we are live. I'll get rid of the got it. Okay. Welcome committee. This is the Senate Finance Committee, and this is Friday, January 7th. Just if anyone missed it yesterday, because they are not accurate and sometimes misleading, we are not doing the closed captioning every day. The YouTube will have a closed caption within 24 hours. And if anyone wants to have that closed caption on any day, just email me and we'll put it up. But it seems to be more problems than it's helpful. I know the few times I read it, it was very distracting and good for a laugh, but not, I wouldn't want to be following the committee process. So committee, today, we have Jason Cadwell with us, and he's asked, I believe over the summer, to talk to us about a few issues that he sees with a lot of our income sensitivity and interactions, I think. So Jason, the floor is yours. Welcome. And
well, thank you, Senator.
oh,
So yes, I believe Faith forwarded a memo that I put together last
Yes.
week to you all, and this this was generated by a number of situations that I'm coming up against, and as you may remember from prior conversations, my work is as a CPA. I do a fair amount of tax returns, but I'm also a certified financial planner, not working in the investment world, but working on the planning side. So if there's a typical client that I deal with, it's somebody 2 or 3 years away from retirement or very close to retirement, or something that's come up more over the last year or so is people being thrust into retirement in these times of COVID, and looking at how they fund their cash flow needs as they enter into retirement. And what I'm finding, which was there all along, is that there are a number of, well, I could say landmines on both the federal tax as well as on the state tax side that that folks aren't really aware of. And it's my job to sort of help them navigate these issues and help them source the funding. So my purpose today is really just to make you aware of these things. And I'm not being critical of any one program. It's just that when you overlay all these programs on top of each other, it becomes a multiple landmines. And so, just a couple things from my memo that I just want to mention. One is a premise that if you have two households that are essentially the same, I'm hoping we can agree that their tax consequences will be very similar. The second thing is that asking just for vocabulary, that when I say tax, I'm using that as a very general term to apply to anything that results in an increased cost due to your level of income. So, and actually specifically calling it an income tax. So if real estate taxes go up because your income goes up, I'm saying that's an income tax. if your health insurance goes up because your income goes up, that's an income tax. So when I'm using the term income taxes rather broadly in my discussion. And then the last sort of vocabulary thing that I'm going to throw out to you is the idea of a marginal tax bracket. And again, I'm referring to this general term of taxes covering anything that's impacted by an increase in income. And the reason so the marginal tax bracket is if your income goes up $100, how much does your tax go up? So how much did that marginal tax go up as a result of that additional $100 of income? And it's very pertinent for the work that I do because I'm working with clients around the edges. How do we source their income? Do they generate a deduction or not? The timing of income recognition and so forth. So that marginal tax bracket is a critical concept in planning work that I do. So, okay with those ground rules or those vocabularies, folks? So we all sort of those
Any
concepts.
questions at this point? Okay.
Okay.
Keep going.
Yeah. Yep. So the example that I threw out again it's actually a live example that I've worked on in the last month, where a couple that weren't anticipating that they were going to be retiring at this point, but because of circumstances that were really outside their control, they're finding themselves retired. And the first question that they had was, can we do what we want to be doing without going back to work? And fortunately, they were in fortunately and admirably, they were in a situation where they had enough resources. So the next question was, how do they source the cash flow needs that they have? Their situation is the husband is over 65, so he's on Medicare, and the wife is under 65, she's 63, so she is accessing health insurance on the exchange. So again, income sensitivity is an issue. Their income is lower, so they have a property tax adjustment, and the spouse with the lower Social Security benefits is claiming her Social Security now, and the husband is waiting until age 70. So they've got that Social Security income, which both on the federal side and on the state side is not taxed at the lower level, but as you go up, that Social Security income becomes taxable. So again, where do they source their cash flow? So the table that's on the second page of the memo that I had Faith send out shows the different breakpoints. Again, their baseline income that we're dealing with is the Social Security income that's about $22,000 a year. So I was looking at, well, where do they source the additional dollars, and how does that, presuming that sourcing will generate taxable income, how does that impact their overall taxes? The first $20,000 of additional income on top of the $22,000 of Social Security is fairly benign. It's generating in total about 10% in taxes, a little less than 3% with additional real estate taxes, and about 7.6% due to the lower health insurance subsidy that they'll be getting. But then the next 10,000 on top of that, so they're at $42,000 of income sources, another 10,000 on top of that, that additional 10,000 generates a marginal additional tax of over 40%. And that's through a combination of the increased cost of health insurance, the increase in real estate taxes, and the increase in their income taxes. The next 10,000 on top of that, going from 42,000 to 52,000, that bracket is generating 49% in taxes. And let's say that some of that additional 10,000 was one of them going back to do some seasonal or part-time work. They've got payroll taxes on top of that. So that puts them up over 55% in marginal taxes. They're coming home with less than 45 cents on the dollar in their pocket from their work. So that's, and what happens is, as their income goes up above these ranges, it starts dissipating that marginal bracket, because what's happening is a lot of these programs, particularly the health insurance program, but also the real estate program, has an accelerant in there at where, by design, and I understand the reasoning, by design, at certain income levels, the intention is to have that benefit fall off. But the consequence is, on the individual level, there's this high marginal rate in these middle income levels, which are still very modest, that people are getting hit pretty hard in these programs. And then once you get up over about $110,000 to $120,000 of income for joint filers, well, they're back into what is likely state and federal, a combined marginal bracket of somewhere between 25 and 30% at those middle upper income levels. So that's really the crux of what I wanted to share with you all. And honestly, I'm raising this knowing that a lot of these programs are not in the Vermont legislation. They're federal legislation. They have to do with healthcare and income taxes and taxation of Social Security. But I can imagine you all are dealing with constituents that are concerned about their tax exposure. And you might think, well, these are people that are on the upper income levels. And what I'm seeing is, once you get in the upper income levels, the tax is going to be the tax, and it's fairly predictable. But in these low to middle income levels, boy, there are just traps that people are not aware of.
Senator Hardy.
Sorry, had to find the mute button. Well, thank you, Mr. Cadwell. I'm curious what your recommendation is. Pretend we did have control over all of this. There are some things that we could change. What are you asking, or do you just want us to be aware of this? What are you recommending?
Yeah, well, I think one thing that's difficult, Senator Hardy, is you're doing your work right at the same time that I'm working about 70 to 80 hours a week. and so it's really hard for me to hop on a call, but I certainly would encourage you to feel free to give me a call if you have, if you're looking at some programs that are income sensitive, and I can do what I can to help understand how these overlay with other programs that my clients are facing. I think that the property tax program is the one thing that's within your bailiwick, and again, the traps that I'm seeing in the property taxes, and again, this is for joint filers, is somewhere between $40,000 and $50,000 of income, and then again, there's another cliff, so to speak, between $90,000 and $100,000 of income, and so if there's any way to kind of dampen those cliffs, or graduate those cliffs, I think, and I'm looking at it from the individual perspective, so I have no idea how that impacts the revenue stream for the state. But that's one tangible thing that I think would be worthwhile taking a look at.
Well, we are going to be looking at going to an income-based tax for property tax, and that bill just came in today. It's 150 something. Senator Hardy, do you know the number? It's Senator Polina's bill.
I don't know the number. Let me just a second.
Senator, it's S212.
It's S212. So you might want to take a look at that and see if you can, if you have any comments. I know when we did redo the tax code, we did raise the level that we exempted Social Security taxes above the feds. The feds haven't. We do control the state income tax, but not the feds. But these are the middle income people that, to me, have traditionally gone to Florida to avoid some of these taxes, at least the folks I know in this area, because that's how you do away with the income tax and probably some of the property tax if you rent or downsize.
I can say just from my experience, I don't have many people in below $100,000 income range that make that move specifically for income tax purposes. I've had clients in the higher income level that have made that shift, and it's not a move, it's more of a shift because they already have a place in a southern state, and they're simply shifting some of the days to Florida as opposed to
6 months in one day.
Yeah, and but folks in the $50,000 to $100,000 range typically don't have two homes.
Mm-hmm.
Far be it from me to understand, they don't like the cold weather in Vermont, so they plan well before their retirement to make that move to Florida.
Okay.
Madam Chair, can I just follow up with one question? Because obviously this scenario that you presented to us in your memo is very dependent on the circumstances of the individuals and their assets and their income and their age and their marital status and all of that. So it's differing. But I mean, I think your point about these people who are sort of caught in the middle of not being super low income and not being high enough income is something that we need to be sensitive to, and potentially there are some areas where just moving up the income, maybe we haven't kept up with inflation, would be helpful. It sounds like, whether it's moving the cliffs to a different, because there are always going to be certain amount of cliffs, but moving them to different income levels.
Yeah.
That
Well, Senator, I think my response would be it's more graduating that cliff. So rather than doing this, it's more of a gradual tapering of those programs. So that's the thought.
That's fair. Thanks.
Okay. Well, keep an eye on us, and if you see we're about to do something bad, let us know. Because I think in general, this is not the group that we want to tax. Is not, older, middle income Vermonters. But you're right. The feds do one thing with the health insurance costs, and then you get people that have one foot in each world, retirement and Medicare and Medicaid and, the exchange, and strange brews get concocted. So that's good to know and for us to be aware of it. And thank you.
Well, thanks for the opportunity and good luck in the season.
Thank you.
Okay, take care.
Okay. All right, committee. We're a couple minutes early, but I think most of our people, this is LCAR issues. And Senator McDonald is on LCAR. I don't think we have anybody else. But this year, LCAR got a rule on stop loss insurance for small employers, like less than, I think it's 25 employees. And I've never objected to a rule, I don't think, but this one, all the insurers objected to it, which caused me some concern. We rarely do something that all the affected parties hate. So I just said that to me was concerning. And I think it got, Senator McDonald, did it get delayed at LCAR? Has it been?
That stretched out. Senator Bray is also an LCAR.
As also on LCAR.
And
there he is.
he may be helpful here. This was in place since last May. The advocate for the public advocate and the insurance companies and others were all over the place, and it played all the way out until around the first week in December, when finally an agreement was reached where none of the parties were happy. But
okay.
But it was long and painful.
Okay. So there is a rule in place, but there are concerns. Senator Bray, can you enlighten us some more?
Well, just a piece to go along to supplement what Senator McDonald just shared. The other part of our discussion and part of the reason to flag it for this committee was that because of stop loss, the use of stop loss insurance and becoming, in order to make it more and more possible for people to leave the general pool and go into self-insurance, we were concerned about what the long-term impacts might be of that in terms of, for instance, companies that tended to have a younger than average labor force might say, well, since we have the young folks, we can get a more favorable rate. They might well be able to do that. And so we could see a tension between an understandable desire for any business to provide healthcare insurance at the lowest possible cost and community rating for the state of Vermont. If it turns out that more and more it's cherry picking of a sort.
It's the pool and the impact on the pool. The more healthy people that get bled out of the general pool, meaning basically the exchange, the more the cost is going to go up for those remaining in the pool. And last year, we separated the small employers from the individuals because of federal incentives that prevented there to be a major change for the individuals. But this also came up. And so Jen Carby is here.
So if I may, Madam Chair,
Yes.
So part of the reason we wanted to send a letter was just to make sure that this didn't go, traveling silently by in the night, and that the Committee of Jurisdiction wouldn't be aware of the questions that came up and the sort of tension that we saw.
So I think, yes, then, so we're going to take a look, and Jen, can you just bring us up to speed as to who's doing what and what's happening?
Sure. Jennifer Carby, Legislative Counsel. And I don't know if you talked at all about took a step back and talked about what stop loss insurance is.
No. So I think you could start us at ground zero.
All right. So I'm going to give you a very high overview. And then if you have more specific questions, there are a couple of folks from DFR, Sebastian Arduengo and Emily Brown, who are on and could probably do a better job answering your questions and are scheduled to testify after as well. But in general, we're talking about stop loss insurance. The context is that we're talking about employers who have chosen to self-insure for their employees' health coverage. And so this is what people sometimes refer to as ERISA plans, which is a bit of a misnomer, but that's a conversation for another day. But these are these self-funded or self-insured plans. And healthcare stop loss insurance is something that those employers can purchase that protects them from excessive financial exposure that could be due to very large, catastrophic, or unpredictable healthcare costs. So they're creating some financial protection for themselves if things go in a direction, are very expensive in a particular year, and it would cap the amount that the employer has to pay, and that's when the stop loss insurance would kick in. And ultimately reimburse the employer for the amount above the cap. There are two different types, and I think usually both are purchased by the employer. One of them is individual stop loss, and that protects employers against very high claims incurred by any individual who's covered under the plan. So it's not looking at what necessarily would happen with the whole group over the year, but just very expensive claim from an employee or employee's family member. And then there's also aggregate stop loss, and that is looking at what the healthcare claims experience of the entire group is. And if those are, far more than were expected, then that stop loss insurance might kick in then as well, depending on what the policy that they've purchased says. So DFR, while they cannot regulate these self-funded employer plans, they do have some role in regulating stop loss insurance, and particularly looking at what the dollar amount or what the percentage exposure is for the employer, so that they're not effectively insuring their entire financial risk while being outside of state regulation, because their plan is a self-funded plan. So their DFR's, part of DFR's role is in ensuring that the stop loss coverage is really what it is designed to be, which is protecting the employer above a certain amount, but still reserving a significant amount of the financial risk on the employer to make it something other than just health insurance by another name. So that's the universe of insurance product that we are talking about right now, is this stop loss coverage and its relationship to employers of various sizes, and at what point that stop loss insurance, what's the minimum amount of financial exposure the employer should have to have before that stop loss coverage kicks in. So that was the basis for the rule. Some updates to those attachment points was the rule that LCAR considered, the DFR filed and LCAR considered. And so I know you have the letter that LCAR sent on your website. Do you want me to pull that up and we can look at that? It names the questions, or do you want to look at it separately?
It probably would be E's committee. You want, a letter is hard to read up. Can people read it on their screens? It is on.
I can just hit, I mean, a lot of it is just giving you the context of what the rule was. I can just sort of name the things that they identified. So this was a letter.
Yeah, that would be helpful.
Okay. There's a letter from LCAR to this committee, also to House Healthcare and Senate Health and Welfare. And it was just from a few weeks ago. And they noted that they had heard this rule, and that during their deliberations, they heard from DFR and from the Office of the Healthcare Advocate about some concerns around the provision of healthcare stop loss insurance. And I think I heard the committee talking about some of these when I came in. So there's concern about adverse selection affecting the small group plans available through Vermont Health Connect, because when small employers choose to self-insure, they may be taking healthier lives out of the market and therefore leaving a sicker and more expensive risk pool that's left. So that's one concern that was raised, was adverse selection. Another is around this issue that I mentioned at the outset about the state being preempted under ERISA from regulating the self-insured plans, which means that all of the provisions that the legislature enacts around benefit mandates and consumer protections and the regulatory processes do not apply to those self-funded plans. So they're outside of DFR's regulatory oversight. So that's another issue that was raised, is that as more small employers, or more employers generally, self-insure, they're taking the ability for the legislature's decisions on appropriate benefits and consumer protections and regulatory oversight away from the state. And the state no longer is able to regulate that. And then third, there was a concern raised about there being potentially limited availability of kind of professional experts out there who can advise small employers who are looking for information about providing insurance to their employees. And I think this was a particular concern raised by the Office of the Healthcare Advocate, which sometimes receives calls from employers looking for information. And the advocate does not, I believe, although I'll let him speak to it, but I don't believe he considers that to be his role. His role is really focused on individual consumers. So those were the issues that LCAR identified as being outside of their jurisdiction, but within the jurisdiction of this committee and the others. And they wanted them to be brought to your attention so that you can explore them if you so choose.
Okay. Questions from the committee at this point? All right, if not, I got to get back to my agenda, but I believe Sarah Teachow is next, right? Yeah, and Sarah is here. And am I right? Did Blue Cross start all this?
Blue Cross did provide some feedback on the DFR proposed rule. And I can talk a little bit about what our concerns were specific to the rule, and then just our large, talk to the three specific larger issues that were in your memo.
Okay, Sarah, but Blue Cross Blue Shield about a year ago started offering this stop loss insurance. Is this part of you set up your own captive?
Yes, we
Okay.
do offer stop loss, and it is through CBA Blue, which is this part of our company that specializes in captive insurance.
Okay. So you're offering this through your captive insurance
Yes.
wing. Okay.
Yep. So, good afternoon, Sarah Teach out with Blue Cross and Blue Shield of Vermont. And as you're hearing, stop loss is a critical component of the self-insurance marketplace that buffers employers from unpredictable or extraordinary high-cost claims. The rules that DFR promulgates around stop loss are intended to protect consumers, employers, and the integrity of the health insurance marketplace. And DFR reviews the stop loss regulation periodically. I believe it's every 3 years, but Sebastian and Emily can get into the details of what they're doing. So when we looked at this rule, and DFR uses an actuarial firm to help them, decide what is the best approach here. When we looked at the impact of this rule, we understood that the modifications were supposed to prevent a situation where a small employer would not retain enough risk for the health insurance that they were offering. But what we were seeing in practice is that's not really the way it happens. And it's because most of the small employers buying stop loss and buying health insurance from us are buying gold plans or better. That not everyone, but the vast majority. So what we see is employers trying to secure comprehensive health insurance benefits for their employees with lower out-of-pocket costs generally than what they can get on the exchange at the best price possible. So that's what we're trying to help small businesses do. And just to the point of avoiding state laws, our health insurance plans mimic what you see on the exchange and cover almost the full set of benefits that are mandated by Vermont law. Not everyone, but the vast majority. It's an extraordinary time to be a small business owner, and having multiple options to secure health insurance benefits for their employees is essential to their survival. In addition to the avoiding Vermont state laws and mandates, the other two arguments that we heard were that one, that small businesses aren't sophisticated enough to understand the risks associated with self-funded health insurance, and that forcing these businesses to purchase plans on the exchange will improve the risk of the pool and the prices for all others. The first of these arguments is paternalistic. Just because they're small doesn't mean that these businesses aren't savvy about health insurance and the needs of their employees. And the second about the risk pool, that impact is exaggerated. There's not a lot of businesses purchasing self-funded insurance, at least in our experience. And to force those particular small businesses to buy insurance on the exchange could increase costs for them significantly, but to the pool of small employers, it would not be a perceivable difference. The actions that this committee took last session, and you talked about earlier, of unmerging the marketplace, resulted in an extraordinary improvement in the premiums for small businesses. And we support continuing those types of policies, but this and mitigating disruptions that could negatively impact small businesses in the state of Vermont. So I'm happy to answer questions, but that's Blue Cross's perspective.
Okay, any questions for Sarah? None. Okay, Senator Bray.
Well, it's good to see Ms. Teach out again. I just wanted to, I think, add a note about the conversation in part in Elkhart. We were entirely sensitive to the notion that every business, including every small business, would want to do the best it can for its employees by minimizing costs to provide healthcare insurance benefits that they'd like to provide. So it had nothing really to do with, I just want to make be really clear that we were supportive of these folks, but we didn't have data to suggest any possible impact for rates on the general pool. And it was more raising a question and then sending the question on to this committee, because I suppose if you extrapolate over time and many people left, maybe that minimal effect or de minimis effect could become meaningful later. So anyway, we just wanted to put it on this committee's radar.
Okay. Senator Hardy.
Thank you, Madam Chair. And just sort of tag teaming off what Senator Bray just said. Sarah, thank you for your testimony. Do you have any numbers about the number of insurance plans that we're talking about? You know, a number of employers that are self-insured that are then buying stopgap insurance, and like, what is it? Only a few? And do we have the data to see what the impact might be?
Right. I don't, you know, didn't bring the numbers with me for Blue Cross. We entered this marketplace relatively recently. So the number of businesses that we're insuring is not high. We do know that there's a fair number of competitors also in this marketplace. But again, for small businesses, I don't think it's a large part of the picture, but it is another option for them.
Mm-hmm. Maybe DFR has some more data
Good
that they
numbers.
can share with us. Yeah. Okay.
Hopefully.
Thank you.
Okay. I think Emily Brown is popping up. Emily, welcome. Do you have numbers
Thank you.
for us?
I don't have specific numbers, but just to give you an idea of the market, like Sarah said, Blue Cross was one of, I think, the more recent participants. But as mentioned before, DFR is responsible for approving all of the forms and rates for these policies. And there are about 20 insurers operating in Vermont right now, or at least who have filings with us. So while Blue Cross is a player, there are several other companies also involved in the market, Cigna being one of them, Sun Life being another that are big players.
Okay.
I don't have specific numbers though.
We don't know how many employers are buying. Okay, thank you. Any other questions for Sarah? If not, I'm going to go on to Michael Fisher. So Michael, welcome.
Good afternoon, Senate Finance Committee. Good to be here. So thank you for Mike Fisher, healthcare advocate. Thank you for taking this up and spending a little time with it. And thank you, LCAR Committee, for a really good letter that articulates a lot of the issues that we were concerned about in a very clear way. I want to first recognize the direction that DFR moved towards in its recent rule, and appreciate it, while we don't think DFR went far enough to protect the Vermont marketplace from fragmentation. We think DFR did, from our perspective, move in the right direction. I also want to do a little bit of a shout out to something that Blue Cross just said, and DFR says clearly, this is a particularly volatile moment. Maybe we should be getting used to volatility, instability in the insurance marketplace, because we always seem to be in it. But it's true. This is a hard moment to rock the boat for small businesses in particular. So I want to recognize that. And then I want to say, just to say as clearly as I can, that the current dynamic for small businesses who are being offered and marketed to join the self-funded world is, I think, very bad for Vermont and for Vermonters for a number of reasons. But I only focus on one, and I know the committee understands it really well. But I just want to emphasize as strong as I can the power of adverse selection. Or to put it a different way, this to us looks like a perfect sorting of small groups. You healthy ones over here, we're going to offer you great rates. You can save some money, and you'd be silly to to not take advantage of it. You want to offer good insurance to your employees, and so you get good rates because you happen to be younger and healthier, and you older, potentially more expensive small groups, you get to go over here. You don't get offered the good rates. You're forced or left with the only option of being in the exchange. And by the way, the healthier ones, you get some bad outcomes. You have a couple of people with some serious diagnoses. You get the safety net. The exchange, the small group, becomes a safety net, becomes a place where you get to back off to if you prove to be more expensive. I, with a little bit of humor, want to recognize that there are times when let me also just recognize, you have Blue Cross in front of you. This marketplace is much bigger than Blue Cross, and there are many other actors there. But generally, there are times when the advocate comes before you and offers proposals of options for individuals. Maybe times when they can buy insurance, and the carriers will say, no, you can't do that because of adverse selection. And here's an example of a time where I think there's broadly recognized concern about adverse selection, and the carriers are saying, oh, well, it's okay. It's not a big concern. It isn't going to cause that much volatility, that much change in the marketplace. It gives me a little bit of humor anyway. I did have a bit of a funny experience I want to relate to you as I walked into Elkhart a few weeks ago. I was thinking about how complicated the interaction of all of these factors are on each other and how hard it was to convey it to you, to legislators. And after the hearing, Senator McDonald sort of cleared my head about it a little bit, and reminded me it's really not that complicated. It's pretty simple. Are we in this together? Are we trying to create a pool where everyone has a great deal of protection because of the sheer number, or are we going to let it fragment? And some people will get great deals and they'll be really happy about it, and a lot of people will be will see their rates go higher. And obviously, it makes me think. I approached this meeting with the question, well, what am I looking for out of Senate Finance? Obviously, it's a good thing to educate you or keep you up to date on this dynamic. That's a good purpose in and of itself. You would get from the healthcare advocate a proposal to do a New York style straight prohibition on stop loss for very small businesses. I think New York does 50 businesses smaller than 50. We might suggest businesses smaller than 25. I don't in my wildest dreams imagine that Senate Finance will take such an extraordinary step this year. So as I reflect on, what's my purpose here or what's my goal here, I want to go back to my very beginning. I appreciate the direction that DFR went here. And I appreciate that DFR clearly wanted a public conversation with legislators to get some feedback about sort of this dynamic of how much to protect the group and how much to allow for the fragmentation. And so it's my hope that this committee can see its way to providing as much support for DFR to move in the direction of really making it harder for businesses smaller than 25 to self-fund, and support DFR's role in evaluating that and taking real action to protect the marketplace.
Okay. I get a question, Senator Bray.
Hello, Mr. Fisher. Good to see my neighbor from up the hill. I have a question. So in LCAR, as you recall, I was raising the question about adverse selection. But the other, and then, what makes this tricky is I think about there are, I've experienced, and I know others have, employment which doesn't include any health insurance whatsoever. So the other side of the coin I worry about a little bit, and I don't know how we quantify this. If this self-insurance option were to go away, how many employers would just stop offering health insurance to their employees? And do we end up practically with a more sort of pure community rating system, but fewer people being offered coverage by their employers? And I don't know how you sort that question out, but I can feel the tension going both ways.
Mm-hmm.
Yeah, it's an interesting question, Senator Bray. Good to see you too from down in the valley. It's a hard scenario to figure out how to answer given the unknowns of this current moment. Are we going to continue to have the first question that comes to my mind is, are we going to continue to have ARPA-like premium tax credits in the exchange? We don't know the answer to that question at this moment. In terms of sort of what is the impact if some or more small employers stop offering insurance, how protected will Vermonters be as they go out to buy insurance on their own? That is an example of an unknown. But I think the question that got asked earlier, maybe from Senator Hardy, also, this is an Addison County crowd, getting a grasp of the numbers of Vermonters. I don't believe DFR has this, but it would be interesting to know how many Vermonters fit this category of self-funded, very small, again, 25 employees businesses. I'm not sure that we have the answer to that, but it would be interesting to know. I think it's quite a few Vermonters are in the self-funded marketplace.
The other question is, how long have they been there? I mean, if they've been there for a long period of time, then the pool we're looking at or have been looking at is reflecting that. If we're suddenly seeing more leaving, then it's really impacting the present pool. And so that is a question.
Yeah, and it's important to, part of the answer to that, Madam Chair, it is a recognition of how slow things change. People don't jump into action often in the world of insurance. It takes a few years. So there's a bit of a lag time.
I think we've also found out that once you give something, it is harder to take it back. We faced that with the association insurance programs, which the feds outlawed, then gave, and then took back, which kind of kept us from having to make that decision, for which some of us were very grateful. But that was having an impact on the pool. And but you're always doing that balance as to, yeah, it'll make it more costly, but at what point do insurers just say, I'm going to give you, $50 more a month and go buy your own insurance on the exchange? And when the exchange came up, we actually were encouraging some employers to crunch those numbers and saying you might be better off sending individuals out to the exchange. So that's always a line you walk.
I will just say a word about the dynamic of businesses reaching out to us at the Healthcare Advocates Office. It does happen. We do consider it a potential conflict to give advice to an employer, recognizing that we may have an employee approaching us aggrieved of their employer's decision around insurance. So our mandate is really for individuals, and with a recognition, the recognition that there's a lineup of people who want to advise small employers about what to do about insurance, who are offering to sell them something.
Mhm. Yeah. Okay, any other questions for Michael? Okay, I am not seeing any. So we're going on to Sebastian Arduego and Emily Brown. Welcome.
Hi, good
And
afternoon.
good afternoon. So, yeah, Michael, Michael, you just became Emily, and Emily, things are flashing on my screen here. Why don't you fill us in? Just give us DFR 101. What do you have? If you've got an employer who is presently in the pool, buying off the exchange, and they decide to go to self-insurance, what power does DFR have? What do you do? And what caused you to make this ruling at this time?
Hi, Sebastian Arduengo for the Department of Financial Regulation. And as stated earlier, I'm joined by my colleague, Emily Brown. With respect to employers that choose to self-insure, once an employer has created a self-insured health insurance plan, the department's regulatory authority over those plans is very limited because of a law called ERISA, which has been mentioned earlier. But what ERISA does is that it preempts states from requiring self-insured employer plans to carry all of the panoply of benefits that are required of fully insured plans by the legislature. And as Sarah was testifying to earlier, the self-insured plans that Blue Cross Blue Shield of Vermont and other insurers sponsor through stop loss coverage or support through stop loss coverage carry most but not all mandated benefits that a fully insured plan would have to cover.
Okay.
So because self-insured employers generally have much greater flexibility with plan design, they can design plans that are cheaper for an equivalent coverage level. So for instance, an employer sponsored plan could offer a plan that is as rich on paper, meaning that the plan covers X percent of anticipated expenses as a gold plan on the exchange, but doesn't require coverage of each specific benefit that we require of fully insured plans. And a great example of this is, so we have a statute that requires coverage of off-label prescription drugs for cancer in 8 VSA section 4100E. It is covered by some self-insured plans, but not all of them, if that makes sense. So think that that's an example of the kind of thing we can't enforce with respect to self-insured plans that are governed by ERISA. So what we try and do in our stop loss regulation, and this is what Jen testified to earlier, is ensure that the stop loss coverage doesn't functionally act as a high deductible health plan. And when we had our actuaries review the market last year, what we found was that for employers that had a group of employees of 25 or fewer, that especially at plans that were equivalent to a bronze or silver plan that you would see on the exchange, the stop loss insurer was essentially taking 60% of the risk, 55% of the risk. Most of the risk of these plans would have been captured by the stop loss insurer. And that was more true the less rich the plan was and the smaller the employer was. So the solution that the department tried to employ in the rule was increasing the attachment point for employers with 25 or fewer employees. And by doing this, we decreased the percentage of claims expected to be seated, but also, as Sarah testified to, it had the effect of making stop loss coverage economically unviable for employers with relatively healthier groups, because what we had done, for instance, is increased the individual attachment point for stop loss coverage to $40,000. But if you're an employer with healthy employees, it's very unlikely that any one of your employees is going to hit claims over $40,000. So for that reason, Blue Cross had advised the department that at that attachment point, it is unlikely that they would even offer stop loss coverage to those very small employers with good claims risk.
Okay, and this is the proposal that was originally sent to LCAR.
Yes.
Okay.
We continued talking with Blue Cross Blue Shield of Vermont and the healthcare advocate, and eventually we reached a compromise in which employers that already had stop loss coverage could continue that coverage at the attachment point that's otherwise applicable to small employers, which in this revision of the stop loss regulation, we increased to $33,200 for individuals, or the greater of $33,200, or 120% of expected claims in the aggregate. And at that attachment point, all of the small employers that are currently enjoying stop loss coverage from Blue Cross Blue Shield of Vermont and Cigna would be able to keep their stop loss coverage and continue to self-insure. So in terms of a compromise, we've made it more difficult for employers to leave the small group market, and particularly if they are healthy, but we have allowed all of the employers that are currently self-insuring to continue with that self-insured coverage and to have stop loss at a level that's equivalent to other small employers. I think one of the reasons that we thought it was important to flag this issue for the committees of jurisdiction is that for the department to go further, as Mike Fisher suggested, these employers, and for Blue Cross, there are at least 7 groups and at least approximately 70 individuals would have to change coverage. And in the middle of a pandemic, that's not something the department was prepared to do. And also with the uncertainty in the small group market in terms of not knowing whether the American Rescue Plan subsidies will continue or not, or whether the market will continue to remain unmerged. So in terms of what we've done, we've tried to maintain the status quo while increasing attachment points to reflect medical inflation. But we would appreciate any guidance that the committees of jurisdiction have in terms of how to protect the small group market from adverse selection, particularly in light of the fact that doing what New York and Rhode Island have done and outright prohibiting small employers from obtaining stop loss insurance would be very disruptive to those employers.
Mhm. Okay, and I assume because we're a smaller market, I mean, New York and say Connecticut or Rhode Island?
Rhode Island.
Rhode Island. No, they've still got a bigger market than we do. That they perhaps don't have the kind of price pressure we're seeing on those remaining small group. So essentially what your ability to regulate is that the small employer can't buy a product that would essentially say, because everybody's young and healthy, unless somebody falls off scaffolding and breaks his neck and is, that they're going to have very little health insurance claims, and that the stop loss basically is going to pay the bulk of their claims. And so you're trying to find that balance. And again, concern about the marketplace, the pool. So what you've done is you've said, okay, the insurance companies came in and said, you wanted to raise it to 40,000, right? So it would only be, stop loss would only kick in at $40,000 an individual.
Yes.
All right. So that, and the insurance companies came back and said, well, at that rate, we just can't afford to offer this insurance. So you found a compromise, which essentially said, all right, you can keep the people you've got with, the 40,000 deductible or coverage, but any new policies you sell, your attachment point is at 32.5, which limits the market, the insurance companies. So they're not going to like that because they've got a smaller group to sell to. And I assume we're now sitting in waiting to see what happens. And again, we've got all the federal chain, you know, who knows what's going to happen at the federal level. It could stay, it could get better, or depending on the elections next year, it could all go away a year from now. So I think, am I right? That's where we are. And we could tell you, no, go back to the 40. We could tell you, but then the onus is on us. Is that correct? For changing this, but I think that's what's happening. At this
Yes,
point, we're waiting. We're waiting and watching.
yes, I think that's the posture the department's in. I did want to just say that you got it the other way around. The groups that the insurers have can enjoy the lower attachment point of
Okay, they get to
33,200.
25 and now they
Yes.
have to go to 32. Stand corrected. Okay. Okay.
And yes, the department's current posture with stop loss is that of wait and see, and just do everything in our power to hold the status quo in place, both for the employers that have chosen to self-insure and procure stop loss coverage, and for employers that are procuring fully insured health coverage through the exchange. But I do believe that because of, I think Mike put it best when he said that when something is, or either Mike said it or you said it, Senator Cummings, that when something is given, it's very difficult to take it away.
Yeah.
And moving further to restrict small employers' ability to obtain stop loss coverage would be, in essence, taking away their ability to self-insure and de facto requiring them to switch plans.
Okay. Yeah. Okay. Senator Hardy.
So thank you, Sebastian. You said that the Blue Cross Blue Shield portion of the program is about 7 groups or 7 employers and 70 individuals that
Yes.
are impacted by this right now?
So those are the groups that were impacted by the change we were proposing to make with respect to employers with 25 or fewer employees.
Oh, your original change, not the
Yes.
compromise change. Okay.
Right. Blue Cross has more self-insured clients with 25 or more employees.
Okay, but do you have the data that I was inquiring about earlier, just sort of knowing in total what the universe is in this area?
So we have, in terms of knowing the entire universe of stop loss coverage, we did ask Blue Cross Blue Shield, MVP, and Cigna to provide data to our actuaries for the purposes of doing the calculations we needed to support our rulemaking, but it's very difficult to know the whole scope of the self-insured market because of the Go Bay decision by the US Supreme Court back in 2016. And in that case, the Supreme Court basically said that self-insured plans that are governed by ERISA are not required to report to the state. So we know how many stop loss insurers that there are because they have to get their rates, or they have to get their forms, excuse me, Emily, approved by the department. But we have less of an idea of how many Vermonters are in self-insured plans because we can't require every self-insured plan to report to us.
And
Got it. What a conundrum.
if I could just add really quickly, this is Emily Brown, DFR. There is a report from the Green Mountain Care Board where they've kind of backed into the self-insured number, because we do know, for instance, the amount of the fully insured market, Medicaid, Medicare, and their estimate as of 2019 is approximately 200,009 individuals who are self-insured. But again, as Sebastian said, that number is not verifiable because of the reporting requirements. But by backing into that number, that's approximately how many individual Vermonters right now are self-insured. And another piece of that we don't know is how many of those individuals are purchasing stop loss or are covered by a stop loss policy.
So that's about 20% of Vermonters-ish are in self-insured plans.
And that's just the employee, not counting family members?
That is also counting family members. That's out of the
so
whole
that's the
population.
total number. All
Yeah.
right.
So maybe this is a question for Senator Bray, because about, so LCAR sent this to us and other committees to look at. What is our role here? Are we supposed to approve something, reject something, or what are we doing, Madam Chair?
We're just being aware.
Okay.
I remember, was it last year, the year before? There was some concern in the committee because Blue Cross Blue Shield did form a captive. And that captive was offering insurance, and this insurance is being offered through
their
that captive section, which is frequently, that's what captive insurance does. It backs up, insurance for the owner of the captive or owners, their private stop loss that backs it up. And so I think just the fact that there was another player in the market, and we had the associations come in, and then the feds outlawed the associations, and that left a lot of small businesses out there looking for better deals. And I assume some of them probably went to stop loss. That's just, there's been a little churning going on there, I think.
So a lot of this is for information, so we're aware that this is happening. And I mean, it sounds like Sebastian and Emily, that the rule that you ended up with, that you proposed to LCAR, was a compromise that wouldn't kick anybody off their insurance, but would create some kind of limit eventually as things move. And so do we have to take action right now, or is LCAR already taken action or whatever? Okay.
I believe LCAR approved the compromise, which nobody loves, but everybody can live with. And that's probably a good compromise. So this really is for our information, because it's one of those things, because we don't regulate self-funded insurance. But if we start seeing more businesses, especially small businesses, migrating out of the small pool, then we're going to have an issue with that pool. Right now, the federal credits are helping, but if the federal credits go away, we're going to have a bigger problem. So this is more informational. Again, I have never gotten a letter from LCAR asking the committee to look at something, and this year we got 2. We're going to look at the second one next week, just for our information at this point. Senator Bray.
Yeah, I mean, just for Senator Hardy's knowledge or anyone watching. So LCAR is not a policy committee, so we're not going to make policy decisions. But as rules come through, there's a back and forth. Sometimes parties are before us pointing out tensions in the rule or something like that. And so when we see something sort of live and in play that's beyond our scope, we'll send a letter to a committee of jurisdiction so that they're aware, because otherwise so much rulemaking happens pretty much out of sight, out of mind for the committee that originates the rulemaking.
7 o'clock in the morning is out of sight and out of mind. I spent many happy years on LCAR, but as a rule comes up, the chair of the committee of jurisdiction gets, sometimes the packets are a couple inches thick, sometimes not so much, and you're given the rule, and you can say, and LCAR can rule that, let's see if I can remember them. The rule is just, I'm losing the word.
Contrary to legislative intent.
Well, no contrary, meets legislate, or is, it just.
Arbitrary.
It's arbitrary. I was getting stuck on eligible. It was arbitrary. But that it's a very limited scope. And if LCAR doesn't approve the proposed rule, it can still go forward. The difference, if the department brings it forward, is that if it gets challenged in court, then the burden of proof falls on the agency bringing it forward without LCAR approval. If LCAR approves a rule, then anyone that challenges it in court, they have the burden of proof. So it's, I got it? Okay, I got a thumbs up from Senator McDonald, who's been on there longer than I have. Senator Pearson.
Thank you, Madam Chair. This is all a little, well, not quite over my head, but we've jumped into the deep end quickly here. But I kind of thought I heard Sebastian saying that a direction from us would be, or clarity of our direction would be appreciated. And I would just offer that, you know, I understand it's always a balancing act, but if it were me, the direction to DFR would be to protect the marketplace from adverse selection. I mean, that you know, we're stuck in this in a population, a low population state, and so little changes make a big difference potentially. But I think for those reasons, I would say we sort of have to just do everything we can to protect the marketplace from adverse selection and wait for the feds to deliver universal health care. And, you know, this conversation would be absurd in any other advanced nation. It's a great shame for us, but.
Yes, it is. And I think that's what DFR has done, is attempted to protect the marketplace from these things getting lowered to someone with 10 employees and only attaching it, you know. But again, to change, well, I guess we would have to take legal action to tell them we aren't going, these programs can't be offered to anyone with less than X number of employees, or these programs can't be offered in the small marketplace, which apparently Rhode Island and New York have done. And we can look at that. We can probably find a vehicle if we want to do it. I'm not sure we're going to find the time this year, but I think that's what it would take to right now, this is the rule as it stands. And if we want to change it, we've got to change it. Senator Bray.
Yeah, I'd like to ask Ms. Brown or Mr. Argungo if, just to make sure I have sort of the dynamic right, what's in play. The higher you move the attachment point, the higher the exposure of the employer. And so for the less attractive it is to be self-insured. So we basically made it a little less attractive by going from 25 up to 32.5. But it's, that's as protective as we've gotten so far, correct?
That's correct.
Okay, thank you.
Or we could say these can't be offered to employers with less than 50 employees.
Correct. Similar to what New York did. Yeah. And when New York did that, they also had a grandfathering provision in place. They were dealing with a similar issue. There were several small employers who had already purchased. So they grandfathered existing small employers who are already self-insured to prevent the disruption in the market.
Okay, so we could do that. So that's something to think about. And there's got to be an insurance bill stuck on that wall somewhere we can use as a vehicle. There will be an insurance housekeeping bill coming through. So we will, if we decide we want to do something, have a way to move it forward. Okay, other questions, thoughts? Okay, thank you, Emily, Sebastian, Jen. Spent all day with Jen today. And Sarah, who else is here? Michael. So thank everybody. I see Eric Schultes. Yeah, no, he's up there. I just didn't know. He's with you.
A member of our team.
He's your backup. Okay. I just wanted to make sure if there was someone that wanted to have something to say, they got to say it. Okay. All right. Thank you, everyone. Thank you, committee. Committee, before we go, I've been working with Senator Hardy on trying to start our work on the weighting study. And we are going to be looking at the income property school funding. We got a bill today, 212. It was Senator Polina's bill, which we believe reflects the thoughts or desires of the committee. Originally, Senator Hardy, when you and I talked around noon, you thought we'd have Abby first, who drafted the bill. Abby has suggested that we have Deb Brighton in. We were going to try and get Abby in, I think, next Friday. I'm back to compacting people, but we're going to have Senator Hardy in next Wednesday as we're compacting testimony, and that will show up in the new agenda to kind of go over the flight plan that's come out. Has given us two things to choose, one is the property tax, and look at that. And the other one is the whole issue of, do we do weights? Do we do grants? Do we do some mix? But she helped me understand the issue. So I've asked her to come in next week. I haven't got her on the agenda today, to walk us through that. but that's something for you to think about. And then we've got English language learners, ELLs, which is probably more compact into Chittenden County. I think I've got one school in Washington, but the bulk of the affected schools are in Chittenden.
And
And
that
then-
will probably start in education. The
That
education.
one, yeah.
Yeah.
So we'll be looking, yes, they're gonna look at that, but we can talk about weights. We've got more information coming from the consultants, I understand, and Deb Brighton has more information than she did when they did the tax study. So we're doing that. We're also trying to chase down Michael Costas and see if he'll come talk to us about the original tax study and give us a summary there. And Senator Brock, yes.
Glad to go back to the tax study commission. If you recall a little bit of the history of that, we had the Blue Ribbon Tax Commission report that came out, what was it, the end of 2010 or 11, somewhere in that range.
About the time the recession hit. So yeah, in that time frame.
And they were unable, they did a whole goal of that just by way of background, and many of you probably already know this, so if I'm being duplicative, please stop me. But we had that study, and their goal was to take a look at all of the taxing in Vermont, because when you touch one of these things, it has the tendency to affect people in the others. And the whole idea of that was to do the entirety of the tax system at one time, so you can see that if you touch this part over here, the effect that it has over here. Unfortunately, they were only able to do they were only able to do a couple of them. They did the income tax and they did the consumption taxes, but they didn't do the property tax. And then at the end of that year, the goal was to go back and have them continue the next year. And one of the three members of the commission was not available. Two of them were. And so we then went off on a tangent in which we looked at the third leg, the property tax, but we didn't connect it to what we had done before. And in the tax, if you remember the study that was done, I don't remember the name of the guy who did it.
He was a nationally known, and it starts with an S, and I
can't remember his name. But what happened was that study was done solely to look at the equity, at least at the time, of the property tax collection in view of Brigham and so on, and nothing to do with its relationship with the other taxes. And so we got then back to 2017, 2018, and in a conference committee, we began talking about that whole issue. I think it was an economic development conference committee, was it, Michael, or was it a finance? But in any case, we got to talking about that, and I know I added an amendment to create this particular commission that we did with Deb Brighton. And the whole idea was to try to pick up where we left off with the Blue Ribbon Tax Commission, recognizing a key element of that. And that was, if we did these two legs and then a period of time elapsed, the legislature would continue to tinker with the tax system and create something that could not be continued, which was the case because there had been so much change. And so Deb's group was designed to come back in and take a look at all of the taxes, all three of the legs, to put it together so that we had a recommendation to the General Assembly that made sense as a whole with all of the elements of taxation. And my concern is we now have theoretically had that done, and for COVID or other reasons, we're again off the track, and we're again going to start dealing with things piecemeal and not dealing with the totality. And so that 2 or 3 years from now, we're going to go back and take a look at all the taxes again, because we didn't do it the first time through. I'm not sure what Deb is going to say when she is in here. I realize that we have the report of the commission that they did, and the notion of going to what is an income-based system for property taxes was an integral part of that. And I'm just expressing the hope that we, in effect, continue with that, and that it does dovetail with the rest of the concepts put out in the Tax Study Commission before we go forward and create yet another problem.
And that's what I'm going to try and do. And I think we saw today with some of those marginal tax rates that I don't think most of us want to hit the, people making $40,000 or $50,000 a year with the kind of marginal tax rates that we saw demonstrated this morning. But again, it was Senator Hardy that said, these are folks that got half a leg in retirement and half out, one's retired, one's not. Individual taxes, but as a code, we need, I think, to make sure that it is equitable, that it's fair. There's all those things that we want to hit. And again, we've got property tax, and what is the best way to assess that, or education funding. Do we want to move property tax was stable? Property used to reflect wealth, and so we taxed property. And then property wasn't so much wealth, your ability to buy stuff. So we moved to taxing sales. And now the suggestion is most of what we're buying are services. And as our population ages, we buy a lot more services than we buy stuff. And maybe we should start thinking about moving more to taxing services and come off of property. And that's something that I think both tax commissions are it's a moving landscape. And I think, we had the whole Tax Cut and Jobs Act, which caused us overnight to have to rewrite our code. And we still haven't dealt with any kind of a medical deduction at the state level. And so we'll see where it goes. But my intention is to do all of this in our wonderful, we're going home the end of April world. So Senator Pearson.
I think Senator Hardy maybe had a question before me.
Okay, Senator Hardy.
Oh, thank you. I don't have a question. I just wanted to respond to Senator Brock, which is, I totally agree that we need to look at the whole picture, but I think it's going to be hard to look at do all the things at the same time, especially given the atmosphere that we're in, where change is especially hard during the pandemic. So I think that if we take a look at this and at this, and Deb is now, I believe, has a model of it too, so we can see the impact on individual taxpayers of moving from not a homestead property tax to an individual income tax. So, I think it's important for us to at least start to look at the recommendations that were in that tax study. And then, if we move forward, we're going to have to phase in whatever we do, and then we can layer on phasing in other stuff too. I agree that we should be looking at the sales tax as well. There were a lot of really interesting proposals in their report about sales tax, but I think trying to make massive changes in property, education tax, and sales tax all at the same time would just overwhelm us and probably overwhelm taxpayers of all kinds. So I agree, and I think we should be looking at all, but we can't do it all this session, I don't think.
I think that's part of the problem. It's just too big, and we just don't have the staff to do this. When we did the rewrite of the code, it started with the administration. And so we had all the employees and the expertise of the administration there. It was how legislation should work. Everybody worked together because it was a crisis. And nobody wanted to charge Vermonters $30 million more in taxes under a tax cut bill. But for us to take on a whole code and do it in 18 weeks, a lot, if we didn't do anything else, maybe we could, but we'll be lucky to get through the waiting study. I think this is the first year I have actually been even thinking about crossover at this point in the session. I usually just take the bills and we knock them out, and we knock them out as fast as we can. This year, we haven't got a lot of bills, but we've got a lot of heavy lifts, and I'm concerned that we're going to have the time to do all of them, the due diligence, and to work out the issues that we're going to need. So, Senator Pearson.
Thank you, Madam Chair. I also wanted to respond to Senator Brock. I remember a time when I used to wonder why the legislature had to always meet. Couldn't they get it right and be done with this experiment? But the reality is it is always going to be ongoing, and tax policy is no different. And I would just point out that the Blue Ribbon Tax Commission, it took a long time, but central to that recommendation was a shift to AGI, and it took probably 7 years, if not longer, before we did that. I also in there was expanding the sales tax to services so it could be shrunken. So I agree with some of what you're saying, that we shouldn't pretend to impact part of our tax code and wish that it doesn't have impacts elsewhere. But I guess I disagree that it has to be an all or nothing. I think this is like everything we're doing in a policy arena, an ongoing, maybe never ending, hopefully, path to improvement, to more fairness and better outcomes. So I hope we won't take 10 years to follow up on these recommendations. And to me, the property tax is a tired one, and the place to start. So anyway, I just offer my pitch.
And we did try and move to AGI. This committee didn't. Ways and Means, because it's a tax bill and it starts there, and all those other reasons. They worked, I think, for 2 years trying to do that. And it was during the recession, and everything they did had some impact on those middle-class taxpayers. And it just was not the time to increase their taxes, even if it was only by $10. I mean, it was the timing, but it wasn't for lack of trying. They did so many runs, trying to figure out a way to do that without negative impact. So, Senator Brock.
Just the only final question, not to prolong it, I would suggest, rather, in addition to Michael Costa, in the event you could track him down, that 2 of the 3 members of the original Blue Ribbon Commission task force, Bill Schubert and Bill Sayer, are still around. And there was, in that case, there was a dissenting report that Bill Sayer did. I think it would be useful for our committee to hear from them as well, since they were on the ground in the trenches, in addition to Deb in the more recent one. And there, I think we get a more balanced picture.
Okay, we'll see if we can trace them down along with Michael. I was thinking that is I don't know what his title was, director, coordinator, that he might be able to give us that census, but we'll definitely, if we can find them, any of them, we'll track them down. And at least it's easier on Zoom for them. Nobody has to travel to Montpelier. So maybe we can get folks to come in and talk with us. Okay. Next week, we're still working through some of the just easier stuff. We're starting to ease our way into the weighting study. And as part of that, we're going to be moving into the property. We have got, I sure faith, I haven't got this wrong, a day on cannabis. We got another cannabis bill today. Apparently when there's money, lots of people know how to spend it. So we're going to walk through, going to hear from the cannabis board and their recommendations, and then we're going to look at other recommendations. And unless there's some reason, there's something else that leadership tells me is in play and we shouldn't move it out, I'd like to move that one out. Originally, I thought when the bill left the Senate, but there's been several bills that left the Senate, that money had been designated for enforcement, for prevention, which was a large chunk was going to after school and summer programs, but that may well not have been in the final draft that went through, but we'll take a look at that and the history and all the proposals. And we'll see where that goes. Okay. Oh, you're getting off so easy this week. But we're getting back in the rhythm. And Senator Brock, it's also, we have your evaluation section, I believe, well, for the weighting study, so that we can evaluate whatever we do to make sure it's achieving what we want. And again, it's that we want to improve services to kids is the reason we're putting all this extra money in, and evaluating if the money we're spending is having a, an impact, especially in schools where we're spending a whole lot more money now.
Well, I mean, the real problem is going to be, and it was not really solved in the weighting study, though, of how do you measure improvement? The UVM course looked at standardized test results. That clearly isn't the only way that you measure success, but it's objective measurement, whereas many of the other things are a lot harder to get at. So I think we do have to do more work to figure out how do we measure whether this is working.
There are some very intelligent people, some of whom with dyslexia, that have a real challenge taking written tests. And then there's people like me who thought they were a game and loved written tests, but were not necessarily any smarter than anyone else. But I did like tests. So, but they aren't a good way to measure improvement, especially when you've got kids that are dealing with such a broad range of issues, be it just not having the resources because of family income or family stress, or changing whole new cultures, inability to get places. There's just for some kids, a major improvement would be something that most of us would never even notice. It might not reflect on their grades, but maybe they're not suicidal anymore. It's hard to measure that. So we'll see if we can figure out a way to do that. Okay. Well, have a good weekend. I think it stopped snowing in Montpelier, but I understand tomorrow the high is going to be -9.
Oh, really?
At least that's what my computer said 2 days ago.
Well, you can hope.
So anything you need, anything you need to do outside, get it done today.
Maybe your computer's reporting in Celsius. It's not going to be that bad after all.
It's not going to be. Oh, you live in the semi-banana belt.